Okay, well, I think we will go ahead and get started. There'll probably be some more people joining, but we'll, in the interest of time, we'll get started here today. So welcome everybody, and thanks for joining this quarterly trend series webinar. We started these a couple of years ago as a way to present some timely topics to mortgage clients and friends in the industry. There's always plenty going on in this industry. I think every time we do one of these webinars, we say, wow, times are really interesting right now. And this is certainly, that is certainly the case right now, as you all are well aware. There's a lot going on from a regulatory standpoint. There's certainly some significant market factors, economic factors with inflation at very high levels, and what the Fed is doing to combat inflation and the impact that that's having on interest rates and refinance volume and the expected impacts it's going to have on purchase volume. So there's a lot going on in the industry right now, and you know, regulation is of course still top of mind, and we'll be spending some time on that today. So we thank you all for joining. We appreciate each and every one of you, and appreciate the opportunity to present some information that hopefully will be valuable to you guys. So just for housekeeping, everybody's been placed on mute. If you have questions throughout, feel free to just drop them in the chat in the app, and we'll get those. Just make sure that those questions are addressed to organizers and panelists. That way, those of us that are presenting today will be able to see those questions, and we can mix them into the presentation here. We can also catch some of them at the end when we wrap up, and we'll also have some time where we open up for some Q&A, and if you feel comfortable enough to take yourself off of mute at that point and ask the question yourself, I think we can give that a try and see how it works. If we get too many people talking over each other, we might have to mute everybody and go back to just try and chat, but we'll give it a try if you'd be more comfortable and prefer to ask your question yourself. So we're also recording this, and we'll be sending out the recording here in the next few days, so you can keep an eye out for that in your inboxes here over the next few days. So again, thanks for joining. We're pleased to have, as we normally do with these trend series webinars, pleased to have Olivia Nicholson on the line with us as well. Olivia leads our business intelligence and data analytics practice at Richey May, and has been in the mortgage industry for 10 years, focused on data and analytics really the entire time. And so she leads all things business intelligence and data analytics for us here at the firm, including what we do around benchmarking of financial performance metrics, compensation for clients in the industry. So she is a wealth of knowledge and information, possesses a tremendous amount of data and information about what's going on out there in the industry. So we're glad to have her today. And we're also joined by Scott Olson, the Executive Director of the Community Home Lenders Association. And Scott's gonna present and share some things with us here after Olivia's slides and comments, and so we'll come back around and introduce Scott a little bit more fully at that point. But I want to bring Olivia in now and hand it over to her, and we'll catch you here in a few minutes.
Great. Well, thank you, Nathan. And thanks obviously everyone for joining us. Kind of a special webinar today, like Nathan said. We're really looking forward to that discussion with Scott. But before we get into that, I'm going to talk about some of the financial trends that we saw in Q4 and kind of do a little bit of an overview for all of 2021 as well. So like Nathan said, my team is responsible both for the business intelligence tool that we've really customized for mortgage, that's called Richey May Analyze. We also have a number of benchmarking and analytics products. So one of those being Richey May Select. That's our quarterly financial benchmarking and peer comparison program. So that's the data I'm really going to be focused on today, so we can talk about some of those financial trends that we saw over the quarter and also over the year. So on Richey May Select, we have over 80 IMB participants, almost 90 now. And actually each participant submits their quarterly financial data, and they're able to see that financial data in comparison to their peers. So a number of different peer groups here. You compare to the total population, drill down by size or channel mix. We also put together kind of a hand group, peer group for each of our participants. So we're really hand-picking some other participants there that we think might be the most beneficial for you to compare to. So lots of opportunity in the program to do a deep dive into what your financials look like and kind of how you shake out in the market. So like I said, I'm going to go ahead and show you some of that data today, get into some of those specific metrics and financial trends. But just to give you a high-level overview of what we're going to see, obviously the big topic of conversation is going to be that big drop that we saw in net production income in Q4. Obviously, this was driven by margins continuing to compress after their peak in 2020. But also really notable is the increase in cost to originate over the quarter. So that really dragged down that net production income figure even further. So I'll also talk about some productivity metrics kind of at the end of my presentation, but really across the board, production, financials, productivity, we're kind of seeing everything declining over the last few quarters. So before I get into any of the financials specifically, I'm going to talk about kind of set the table with some origination figures. So just so you know, all of the data that I'm going to be showing here today is our entire Richey May Select participant base. So this is going to be, companies of all different shapes, channels, sizes, any of that sort of thing. So really intended just to show you some trends in, the movement and averages that we're seeing over time. For this report, I'm showing you a view of the last 5 years. So looking back to the end of 2016, we can kind of see total average originations over time, how that's trending. Definitely, you can see at the end of this graph here that production came down just a little bit more in Q4 than it did in Q3. On average, it was down about 7% for the quarter. Not entirely surprising. Obviously, rate changes played a role in that, but even just seasonality, this is kind of a normal move that we might see for a Q4. And I'd like to, I've been saying this every quarter for the last however many quarters that we've kind of seen this number start to dip. But as you can see from this graph, this is still very high in comparison to historical norms. So the previous high for production that we saw before 2020 was in Q3 of 2019. And this past quarter was still 1.5 times that number. So we're still, even though it doesn't feel great compared to what we saw in 2020, we are still very high here. And then because we are talking about Q4 numbers, we can look at the full year. So actually for 2021 compared to 2020, we were up in total production. Obviously, the reason for that, even though it might not have felt like it kind of towards the end of the year, but the reason for that is differences in Q1 production. So in 2020, we definitely didn't ramp up until mid to late Q2. You can see Q1 2020 was still kind of back at that historical average. But that continued boom, took us through Q1 of 2021. So that really pulled up our total year production, which was up 5% for all of 2021 compared to 2020. And then finally here, in terms of production mix, those are those green versus blue bars that you see on the graph. The refi share stayed right around where it did in Q3, so about 33% of total production, but for the full year, it dropped to about 40% compared to 50% in 50% in 2020. So definitely, going to be interesting to see over the next several months as we're approaching purchase season, and then also, rate changes, this refinance, share kind of trending in a certain direction. Just going to be interesting to see what that does to our total production, based on all of these market factors colliding together. So that's what production looks like. We can go ahead and get into some of the financials. The first one I'll show here, I'll spend some time on, is our net production income number. So for anyone who does not participate in Richey May Select, or if you haven't heard me talk about this before, just kind of a high level benchmarking reports that we provide. So those include net production income, which is what you're seeing here. This is intended to show the profitability of just your origination platform. So the difference between that and kind of your GAAP net income reporting, which we also provide, is that we are removing anything related to servicing just to get you an apples to apples origination comparison. We are also excluding your unfunded lock pipeline just to kind of smooth out some of those differences you might have from your unrealized pipeline quarter to quarter. And then we're also excluding loan loss reserves and any outside activity that's not related to origination. So this graph, net production income, we can see that this dropped by 38 basis points in Q4, which is about 40% from Q3. Definitely the biggest drop that we have seen in one quarter in a while. In terms of percentage changes quarter to quarter, some of those quarters in 2018 and 19, we had a big percentage change, but keep in mind, obviously, we were dealing with much smaller numbers back then. So just in terms of like an absolute value basis point change from quarter to quarter, you're going to have to look back several years before you'll see this sort of swing. That is definitely echoed by the MBA report. I'm sure a lot of you saw came out a couple of days ago. They quoted an $1,100 decrease in net profitability per loan quarter over quarter. That's the exact number that we saw on average across all of the participants in our program as well. So definitely, a huge drop across the industry and something we haven't seen in several years. So we're at about 55 basis points on average for that net production income figure. Looking back historically, I'm going back to the beginning of 2012 here, which is the inception of the Richey May Select program. So I'm showing you all of the data that I can just to kind of show you how this number shakes out across historical averages. I would say it is right about average, but obviously very, very low compared to what we've seen for the last couple of years. And keep in mind, again, like I said, we are excluding servicing from this number. So anyone with an MSR portfolio, hopefully some of this trend might be offsetting as we see prepayment speeds, slowing down, but definitely from an origination standpoint, profitability fell considerably over the quarter. And again, just to talk about a full year basis here, our total year net production income for 2021 is down 60 basis points compared to the full year of 2020, and that was about a 40% drop. So obviously not surprising coming off of 2020, just because, obviously we had more than one quarter in 2020 of profitability that was multiples of anything that we had seen in prior years or quarters before that. So that's kind of your total, net income trend and getting into some of the details behind that. Starting on the revenue side, we can talk about secondary gain on sale. Obviously, that's going to play the biggest role in our net production income number. Just one more reminder here. I know a lot of you like to do comparisons as you're watching these. So definitely keep in mind that because we are taking the average of our entire Richey May Select program, this is going to be, like I said, lenders of all shapes and sizes. So definitely if you're more on the retail side or heavier TPO, if you're particularly large or small, your number is not going to line up exactly here, but really just intended to show you some trends. So definitely you can see that we dropped again this quarter, another dip in the quarter in secondary gain on sale. We were down about 14 basis points on average compared to Q3. That was about a 4% drop. Comparing this number to the peak that we saw in 2020, this past quarter, we were down 94 basis points or a 20% drop. So like the net production income charts we just saw, we're now hovering right around historical average. Definitely still a little bit higher than we were for the last couple of years before 2020, but definitely, no longer anywhere near those peaks that we saw in 2020. So that's where we see that drop in net profitability on the revenue side. Unfortunately, when we start to talk about expenses, it's the same kind of story, kind of getting it from both angles, both forces working against us here. But this graph is showing you the total cost to originate on a dollars per loan basis. Simple calculation I'm doing here, so just summing up any expenses that would show up on your financial statements. Again, I'm removing anything related to servicing just to get an origination comparison here. And then I'm dividing that by closed loans over the period. So these costs went up again this quarter on a per loan basis, both in personnel, which are those blue bars that you see on the graph, and then also your overhead operations costs, which are in green. Obviously, you know, just given the quarter, this isn't necessarily surprising because we do have a lower number of loans over the quarter that, you know, we're allocating some of that overhead revenue to a smaller pool of loans. Also in Q4, we tend to see some bonus payouts or accrual, so those costs tend to go up in Q4. But this is the highest all-in cost to originate that we've seen on a per loan basis. So we have passed the $10,000 mark. When we're looking at all of 2021, we come out to just about $9,000 per loan, a little bit over that, and that is over a $1,000 increase compared to all of 2020. So definitely, you know, some challenges here on the cost side of the equation. You know, we're facing decreased production. Definitely, it's obvious that we're still trying to understand how to come back to equilibrium on some of those staffing and personnel related costs, and at the same time we're not able to let up on any marketing or technology related expenses. So a lot of different factors kind of at play going on here. All right, so the last slide I have here on our benchmarking data, I went through production, finance. I just want to leave you with some efficiency metrics as well, kind of on the operations side. So in addition to all of the financial reports that we provide in Richey May Select, we also do some personnel reporting, and that's going to help you understand both your total headcount distribution compared to your peers, but also how effectively and how efficiently you are using that headcount. So the way we do that is we're tracking closed loans per employee and putting that into some different headcount groups that you see here. So this report is showing closed loans per FTE, that stands for full-time equivalent. High level way to think about this is just a calculation of how many loans were closed over the quarter per employee on your payroll in that same quarter. We are accounting for employees who, you know, started or left the company kind of halfway through the quarter, so definitely you're always going to be getting an apples to apples comparison here. So looking over a 5-year period here on this chart, I have this broken out by sales employees in those blue bars. I have fulfillment departments in green, and then finally your back office staff is there in orange. So kind of you can see this is following the same general trend, unsurprisingly, that we saw in the production chart. So peaks in 2020 and then gradually kind of backing off since then, definitely starting to dip down. We are right now right at or a little bit lower than we were across all those departments in 2019, right before things started to ramp up in 2020. So definitely keep that in mind. You know, I know that this is top of mind for everyone right now, but this is definitely the time to try to recalibrate staffing, kind of get back on level footing in terms of efficiency. You know, just as we look forward to production trends in the coming quarters, we don't want to dip below those historical averages, you know, as things start to change in the coming quarters. So just talking about raw numbers here, Q4 closed loans per employee, and that's going to be across the entire company. That was at 1.75 for Q4. And then just for some reference here, when you're comparing that to the peak that we saw in Q3 of 2020, which was 3.25 closed loans per employee, that's about a 45% decrease. So think of that as 45% less closed loans per employee this past quarter compared to the peak that we saw in 2020. So that's really what I wanted to cover for data and benchmarking this quarter. Definitely feel free to reach out if you have any questions. But now I'm going to pass it back to Nathan, who's going to introduce Scott before we kind of lead off our discussion on regulatory trends and some of the market changes that we're seeing recently.
Thanks, Olivia. That was great. Great information, not necessarily great news, but great information. And I don't know that it would be news to any of you. You're obviously living this on a daily basis, and you're seeing this happen in real time. So, but appreciate, Olivia, the time you spent pulling that together and sharing that information. So yeah, I just want to introduce Scott Olson. Many of you probably know Scott, or at least know of him, but I want to just bring him into the conversation here, and Scott's going to share some thoughts, and then we'll open up some time for some Q&A that I'll moderate. I'll field those questions that come in from those of you that are participating today, and we'll engage in a bit of a conversation here about what's going on from a regulatory standpoint. But just to introduce Scott, Scott is the executive director of the Community Home Lenders Association, which is a national nonprofit association of small and mid-sized community-based lenders. The mission of CHLA is to promote federal mortgage programs, rules, and regulations that treat community mortgage lenders fairly and that reflect the critical importance that community mortgage lenders play. Scott has over 20 years of experience working on Capitol Hill, including 15 years on the House Financial Services Committee, where he held the title of Housing Policy Director. He worked extensively on housing finance issues, including GSE reform, FHA legislation, mortgage regulations, and mortgage servicing issues. Scott also has 6 years of private sector experience as a public finance investment banker and 4 years of experience in commercial real estate finance and investments. So we're excited to have Scott today, and look forward to hearing his thoughts. And then again, we'll take questions from all of you, and we'll engage in a little bit of a discussion here together on this important topic. So hand it over to you, Scott.
Well, great. Good afternoon to everyone. And Nathan, thanks for the opportunity to speak today. Excuse me. My name is Scott Olson, and as Nathan said, I'm the executive director of the Community Home Lenders Association, also known as CHLA. So I don't know how many of you are familiar with us, but we are the only national association that exclusively represents IMBs, and our members are typical Richey May clients, smaller non-bank lender servicers. So one of our top priorities is educating policy members in Washington about who IMBs are and advocating like a laser for things that affect those firms. IMBs have a great story to tell. And so in order to tell that each year, CHLA releases a detailed report on IMBs that tells that story. IMBs now originate over 60% of all mortgage loans, over 70% of all Fannie Mae and Freddie Mac loans, and over 90% of all FHA and VA loans. And this represents a significant change from just 13 years ago with the 2008 crisis. After that, PLS market collapsed. A lot of banks got out of the business or imposed credit overlays, and IMBs filled in the gap. The other big thing in Washington these days is the issue of access to mortgage credit, particularly for minority borrowers and other underserved borrowers. And here too, IMBs, and particularly smaller ones, lead the market there too. It's not my spin, but facts and statistics and reports back this up. For example, a 2020 Greenlighting Institute report in California found that, quote, women of color are more likely to get a mortgage loan from a non-bank than a mainstream bank, unquote. And further, that non-bank lenders make twice as many loans to low-income borrowers as mainstream banks do. And the Urban Institute regularly publishes mortgage data that show that IMB mortgage loans consistently have lower median FICO scores, going deeper down the curve, and higher debt to income ratios than bank loans. So the second thing CHLA does, has increasingly in the last years done, is to confront, unfortunately, what we see as a sort of a cottage industry in Washington, proliferating this false meme that IMBs are this next great risky category. They're unregulated, they're unrisky, and we need to watch out for them. And honestly, those claims are kind of laughable. When you peel back the facts, the fact is that IMBs have stronger consumer protections than banks. I mean, let's look at the SAFE Act, where non-bank LOs have to pass a pre-licensing courses, take the SAFE Act test, pass an independent background check, and do continuing education each year. And banks don't have to, bank LAs don't have to do any of those things. In fact, there's thousands of bank LOs that actually failed the SAFE Act test, and they're registered to do mortgage loans. And the other areas in CFPB supervision, where of course every IMB is subject to the CFPB, and 97% of banks are exempt. So do these things matter? Absolutely, because that sort of steady drumbeat about, oh, there's this great risk about IMBs sort of exerts pressure on entities like Richey May and FHFA to beef up financial requirements for IMB participants. And so right now, at this very moment, we're pushing back in letters and communication to the agencies. For example, FHFA recently said that they want to get into the business of directly, examining seller servicers, which we think makes no sense, and have said so. They're proposing a new liquidity requirement on seller servicers, non-bank seller servicers, which will be a 2% add-on ratio for TBA hedging. And of course, last year, Richey May, and this is still pending, proposed to create a new risk-based capital requirement for non-bank issuers. So, whether or not your firm is a CHLA member, we'd love to have you join our fight in pushing back against these things. We don't think these sort of bank-like regulatory requirements are needed to address their role, which is counterparty risk of the GSEs. And we believe that this kind of advocacy can be really effective. Last year, CHLA was clearly the first and most vocal national group to push back and call for a suspension of these PSPA restrictions, which were placed on Fannie Mae and Freddie Mac higher risk loans, on Fannie Mae and Freddie Mac second mortgage and investor loans, and on IMB's access to the cash window. So we made this our top priority last year, and we were very pleased in September when those PSPA caps were suspended. This year, we're turning our focus back to FHA. CHLA has long been a leader in advocating for an end to the life of loan premium policy and to restoring premiums back to their pre-2008 crisis levels. That's not easy. The PMIs are out there pushing back hard against FHA and against these sorts of things. But, if you look at the facts, FHA is overcharging for its loans. And there are some indications that, FHA is trying to get comfortable with COVID loan performance, and that we may not be that far away from seeing some action on premiums. So finally, before I wrap up, everyone's favorite topic, regulation. We haven't been shy about wading in there to talk about, our favorite regulator, the CFPB. So what we have done over the years and what we're doing now is to focus on communicating to them what it's like to be a smaller IMB. And that means that a lot of IMBs are not being audited by the CFPB, not in touch with them, but have a legitimate concern that the CFPB is lurking and out of nowhere could whack them with fines, even when you as an IMB believe that you're complying with all the rules in good faith, and even your state regulators are saying you are. So the CFPB spends plenty of time talking to the big banks and the big IMBs, and so we sort of see it as our goal to make sure they hear this perspective, which we think is somewhat unique or distinct. And our top recommendation is clear: no regulation by enforcement. That is, no retroactive fines where the CFPB comes along and said, "Oh, you haven't been doing this right, so we'll hit you with a fine or other penalties." And we've tried to lay out the case that that's particularly unfair to, this regulation by enforcement is particularly unfair to smaller IMBs because they don't have the economies of scale, the loan volume, to justify hiring fancy DC lobbyists or consultants whose full-time job is to track the CFPB. The other main regulatory issue that's growing for IMBs has been states, like New York and Illinois and maybe California next, adopting CRA for IMBs. In the same way that it was futile for King Canute to try to stop the tides from coming in, it's pointless to try to stop CRA in the states that seem determined to pass this. Now, the states that have adopted CRA so far have no idea what they really want. They just sort of pass this generic language. And then it's up to the state regulators to develop the details about what that means. And that's very important. So CHLA is focused on recommendations to states like Illinois on how to do CRA in a way that doesn't harm all of you. You know, things like a safe harbor if you have a satisfactory HMDA record of lending to LMI borrowers, like pushing it back against mandates to serve certain geographical areas in a state, and like fighting shakedown schemes where firms are effectively or you know, forced to contribute to affordable housing or housing counseling. So, you know, I worked in Congress. I'm a big fan of affordable housing, but honestly, if a state wants to promote that, it can fund it directly, or, you know, they, with the billions of dollars in HUD block grants they get for that very purpose. So in conclusion, these are the things that CHLA and our members are focused on. And if you want to learn more about us, our website is communitylender.org. I've tried to touch on areas that I hope are of interest to your clients, Nathan, and look forward to your questions.
Great. Well, while we wait for a couple of them to come in, I was just going to touch on one, you know, that last point that you brought up there around CRA. So which states right now, Scott, have already enacted those laws, and what others do you, are you hearing about? Do you see as potentially passing similar laws?
So, of course, the one state that's had it since 2007 is Massachusetts, and I sort of got into it. I did an op-ed in Housing Wire on this, and then did a debate with one of the consumer groups, and they were trumpeting this Massachusetts miracle and sort of caught us unaware. So we went back and did the research and found that actually the proportion of business that was done by IMBs went down after CRA was passed. So we don't think this sort of thing actually works. But we've had Illinois that's right now in the middle of, they passed a law, they're in the middle of figuring out how it's going to work. We had New York more recently that passed something, and there's some serious questions there. You know, if you're doing business in the metropolitan area, are you going to be asked to do business statewide? Are you going to be asked to go into, you know, set up branches in inner cities? Or, you know, what is it going to mean? Is CRA going to mean what it has meant for banks, which is you can't really lag the world? Or is it going to be kind of like a mandate to go forth and do even better and sort of continue to, so, and the other one that's out there, we're seeing California start the legislative process, and my guess is that's just a matter of time. So those are the ones that have done it, and California's probably next, and there'll probably be others.
Yeah, California doesn't tend to follow very far behind other states that enact laws, right, to regulate financial institutions or whatever else.
Yeah.
So just a reminder to everyone, if you have a question, drop it in the chat function there in the app rather than in the question box. That way it'll come to all of us that are presenting and the organizers. But one question for you, Scott, here is, what are you hearing on the recent CFPB pronouncement regarding expanding their enforcement authority and broadly enforcing UDAP? Any insight there?
Yeah, you know, this was a huge issue during Richard Cordray's reign, which is, what did that mean? Because, you know, there are a lot of people that believe it's all in the eyes of the beholder. And, you know, one of the things that, you know, any IMB ought to have is guidelines. They ought to know what the rules of the road are. And UDAP is, you know, particularly tricky because it's so general, and it does allow the CFPB to say, well, we looked at this practice and it's unfair and deceptive. And so I think it absolutely bears taking a look at. Now, one of the things, my observation has been sort of like the dog that hasn't barked so far. I mean, I think you could argue, compared to the last regime under a Democratic CFPB director, that the CFPB has not been that active in the mortgage front. However, I don't think that that's going to continue indefinitely. And I think the fact, I mean, you know, this UDAP thing was broad, and they're clearly going out there, they're looking at financial practices across the board. And so, you know, it's possible that they will be looking more focused on things like what banks are doing. But I think it's, you know, people have to keep an eye on this because, as I said, it just, people don't know what it means. And so, you know, our members, we've had endless conversations, and it's this constant conundrum. How much time and effort do we spend hiring outside consultants, hiring outside lawyers, having our own staff look at what they're doing so that we know that we're not going to be surprised? As I said, even though I think all our members, I think, feel that we're diligent about following the rules, and people are trying. And so, you know, I think the standard ought to be that unless you're knowingly, intentionally doing something that's clearly harming customers, that if you are found by the CFPB to say you're not doing something the right way, that it should be a biblical solution: go and sin no more, not go, you know, huge punishment for what's happened before. And, you know, that sort of distinction is really up to the regulators, and we're hoping that they're going to take that approach, as opposed to, you know, what some people felt in the last 2 iterations ago was kind of setting an example by having big fines against certain players to try to, you know, scare people. So, but yeah, you've mentioned, I think, one of the most important things to pay attention to.
Yeah. You know, another one, you talked about that false narrative, and this is a question for me. I'll get back to the others here that we're getting in, but you mentioned that false narrative that exists in Washington, you know, and not just restricted to some circles. I think probably pretty broadly in Washington, around the risks presented by IMBs and the fact that they feel that there's an outsized risk presented by IMBs versus banks, and so on. And so, I mean, how confident are you that that narrative is changing or can change, or maybe the inverse of that? Like, how concerned should participants on the call today be about the impacts of that narrative continuing to you know, be the dominant narrative in Washington?
I think we should be concerned, and we're obviously trying to push back, but I think the other way that we're trying to push back is by arguing the facts. I mean, 3 years ago, our members had sort of the perception that Ginnie Mae was trying to, you know, constrict its issuer base. I mean, members were saying all of a sudden we're not getting commitment lines that we're asking for, and they seem to be asking for more than the requirements are. And so we put out a pretty extensive report on Ginnie Mae, arguing that, you know, honestly, their risk is extraordinarily low, and they actually have a statutory duty not just to not lose money, but to actually promote access to credit. And when you look at it, I mean, Ginnie Mae has like almost no risk. You know, they're concerned about not having an IMB make an advance. Well, okay, fine. But even if the IMB didn't make the advance, the loan's still backed by the federal government. So it's like an FHA loan. So, you know, it's almost like we sort of see a lot of times that the standard is being set that no one should ever go out of business. And that should not be the way Ginnie Mae or Fannie and Freddie set their standards. It should be to balance, under the statute, doing loans with not taking undue risk. I mean, Ginnie Mae didn't even lose money in 2008. It's remarkable. And so, you know, we think that the most important thing, you can't stop the banks. You know, we see this, and we know that some of the big banks are behind this and other players are behind this to push this line, and you can't stop it. But what you can do is argue that we shouldn't overreact, and that these sorts of proposals for Ginnie Mae issuers or for seller servicers, that you shouldn't go too far because there's no real risk. Same thing with Fannie and Freddie. I mean, they don't have any real risk. Their risk is that if IMB made a bunch of bad loans and the Fannie and Freddie asked them to repurchase them, and they went out of business, then they might not be there to repurchase them. I mean, that's a pretty indirect risk. The same thing on the advance risk. So they don't make an advance, well, you know, that's not really a big deal. So we're trying to focus on reality and make the case that you shouldn't keep expanding these requirements to sort of, and you know, the other thing we're pointing out is, you know, it's actually counterproductive. The more you kick out the smaller players, the more concentration it is, and that's where all the risk is. So if you raise standards and push out the smaller issuers, the smaller servicers, you're actually increasing risk to Ginnie Mae and Fannie.
Yeah, increasing the number of too big to fail banks.
Exactly.
Which they also have a problem with, right? It's this
Yeah.
kind of like you're arguing two sides of this in Washington, and it just, you know, because you can make the argument that an independent lender that goes out of business and Ginnie has to go and take a servicing portfolio away from them and put it somewhere else. I mean, moving a couple, maybe few $1 billion in servicing to one of the big servicers is not that big of a challenge, but trying to place a couple or few $100 billion of servicing somewhere else is more problematic, right? So you could say that, to your point, there's actually less risk when there's less concentration of servicing. And,
exactly. Let me say, you know, we've been making the case, CHLA, for some time, that these financial requirements should be different for the large banks, the really large servicers and the other ones, or issuers and the other ones. And we're actually, I think we're making progress. We sort of got through the last iteration that FHFA came out a few weeks ago, dropped some things like this extra ratio for non-performing loans, and instead imposed a risk assessment and some planning for the large servicers. So we're starting to see our message getting through with the regulators that the big players are the big risk, and so there should be requirements proportional to that, and not, you know, have it across the board and pile on the little guys. So I think we're making some progress.
Good. One question here. You know, what should we expect from Fannie, Freddie, and HUD, you know, over the next year? Lots of change, or are they going to be kind of on autopilot? What's the expectation?
That's a great question, and you know, I hope that I can have a better track record in answering that question than I did on my NCAA brackets as I reviewed them this morning.
Yeah.
But you know, FHA is plagued by a constant problem over the last decade that they have to have their commissioner confirmed by the Senate, and that's becoming increasingly difficult under both parties. And so we've been, now it's in the 15th month of the Biden administration, we still don't have an FHA commissioner. We have someone appointed, I mean, someone named, Julia Gordon, but she's still waiting on confirmation. And I think most industry participants would say that the sort of decisive things, both on the large scale and sort of small bore things that FHA should probably update, you know, are not moving as quickly as they could. So I don't see anything soon. And but on FHA, as I said, we're starting to see signals, and I think especially if Julia were confirmed, that this summer or this fall we could get some movement on premiums. We think there's a lot of other issues that FHA, sort of small bore issues, that FHA should focus on, but don't expect anything soon. Fannie Freddie, things are moving at a much faster rate. You know, earlier this year we had some increases on high balance loans and on cost, you know, fee increases on second home loans. We also had a growing problem that some of you may be concerned about, which is these condo certifications that Fannie and Freddie are now requiring in the wake of the Surfside Tower collapse in Florida. And we're hearing that you know, some of the associations are balking at signing these, and that's making loans difficult to do. And so you know, we're focused. We're actually having a meeting tomorrow on that with one of the GSEs. We're concerned about that. And it's clear that Sandra Thompson, who's the head of the FHFA, is a decisive person, has made a number of changes so far. She's reopened the capital rule. She's doing a lot of things. And so, you know, that's going to continue to change. People have to stay on top of what's happening with Fannie and Freddie. So I think a lot more change on that front. And of course, this morning, this big announcement from the White House of this new appraisal bias task force at the White House. And so I think we're going to see things coming up. I mean, there's some talk about lenders being responsible for whether there is loan biases in AVNs. You know, we have concerns about that. I mean, is that the appropriate role of a lender? So, you know, pay attention to that, because clearly that and the sort of the issue of fair housing, which we think the CFPB is going to increasingly and HUD are going to focus on, you know, the clearly administration, it's a big focus about, you know, minority homeownership and discrimination. So,
yeah. How likely do you feel? I mean, what are the odds at this point, Scott, if you had to place some odds on it, that the FHFA is successful in their attempts to kind of directly, you know, have kind of direct examination authority of independent lenders?
I mean, it's something that they're hinting at. I would think that there's various ways this could play out, you know, just like CFPB doesn't examine all IMBs. You know, people are already doing reporting. If they need to sort of channel the reporting you're already doing to the FHFA, that's fine. If you want to look at the very large ones, we wouldn't have a problem with that. So it's really, you know, how big not just whether they'll do it, but is this going to be a significant thing or minor? I think they're going to do something, but we hope it's going to be appropriately limited. So,
I mean, does that have to go through Congress to expand their authority? Because it's not really, you know, it doesn't seem like that's part of their charter, right? Which was to really provide oversight over, you know, Fannie and Freddie.
well, so when FHFA as conservator is sort of like God, I mean, they can effectively do whatever they want. So I think that they're obviously citing their concerns about counterparty risk. I mean, we think that's very much overblown, but they clearly feel they have the authority to do that because they're quote unquote watching out for. But our point has been, you know, it's like the PMIs. You know, FHFA set capital standards for the PMIs because there's a counterparty risk component. Fine, you know. FHFA is requiring Fannie and Freddie to set capital and net worth requirements. Fine. I mean, we think they're probably too high, but that's an appropriate, you know, having them make sure that Fannie and Freddie are acting responsibly. I mean, Fannie and Freddie already do things like moral audits and a whole bunch of things as your clients are aware. And so they're already sort of into IMB. So we just think it's duplicative and unnecessary. And we hope that whatever they do would be streamlined. So it's not that we're worried about new requirements. It's in that area so much. It's just more duplicative regulation that doesn't serve any purpose. So
yeah, sounds good. I think that's the end of the questions that came in. But I do have one, you know, that might be of value here, and that is like what one or two things, Scott, those that are on the call today, what one or two things should they really be engaged in and focused on, you know, trying to do?
So I guess
in this area. Right?
Yeah, number one is, you know, clearly the administration and the independent agencies like the CFPB and the FHFA are focused on, you know, fair housing discrimination and so on. And I think every IMB should be tracking their numbers, their HMDA numbers, and looking at, you know, minority lending, looking at low and moderate income lending, and maybe looking at geography. And if you have concerns about your numbers, start thinking about how to proactively deal with that, because that does potentially put you in the crosshairs, given that this is such a big focus at the national level and by a whole range of different players. So that would be number one. And number two, it's more of a business judgment that I'm not obviously qualified to make. What does the potential run up in interest rates and the environment out there, all the numbers that we just heard from Olivia, what does that mean for your firm and where are you headed? And the good news is we've had a good run up in prices, so we're not going to, I don't think, have a replay of 2008, even if we have a soft spot. But what does this mean for your company? Are you positioning? Like I said, it's not something that our organization works on, but I assume every one of your clients out there is sitting around thinking about this, and this changing market environment. What does that mean, and how what are my expenses and what are my profits coming in? So,
yeah. Thank you, Scott. That was great and very timely, obviously, given everything that's happening right now and everything that those that are on the call today need to be paying attention to. So thanks for sharing your insights and based on your work there on the front lines in Washington and going to work for independent lenders, and I appreciate the work that you do, and so thank you all that joined today. Thank you all for joining, and just want to make one last little comment. You'll get a little survey that pops up here as we wrap up the session today, and I think it's only a couple questions. If you wouldn't mind just responding to a couple questions there, that would be much appreciated. And again, thank you all for joining today. Hopefully the information was valuable to you, got some insights, and we'll look forward to seeing you all again here with our next quarterly trend series webinar in 3 months. So thank you all. Have a great rest of your day.